One of the major drivers of inflation will probably surprise you. I know it surprised me when I learned about it. We are going to get to that in a minute, but the first question is, why are we talking about inflation today? Well, the numbers just came out for January. This was kind of a big important day. The Fed has announced that they are planning on lowering interest rates this upcoming year, so they're still tracking inflation very closely. Um, so the numbers came out overall about 3.4%, up from I think 3.2 the month before, down core down to 3.9. So this excludes food and gas. So core still coming down, but you can see kind of inflation has gotten sticky. So what do we expect inflation to be doing in this upcoming year? Can we believe that the Fed is going to be lowering interest rates, which is so important for the economy? Well, we got a lot of information on that, and this most important driver is shockingly this: do you believe the American consumer? Do you believe that inflation is getting better or cooling or coming down? And that may be surprising. I know when I learned about this, I thought, like, sign me up to be an inflation predictor, because believe it or not, the two things that are very important to predicting what inflation is going to be like in the future is, what is inflation now, and what do we think it's going to be in the future, right? Two things that are pretty easy to understand. So, for example, inflation over the last 15 to 20 years has been very, very low. For the last 10, it's been kind of averaging under 2%. So if inflation is 2%, and it's been that way for years, the next year is probably going to be 2% again, because the economy is like a train. It's tough to get moving and slow down. So we expect inflation to be relatively persistent until there is something that is a major disruptor, like COVID and the supply chain disruptions that kind of threw the economy into whack. We got all this money during the COVID spending, and we kind of really didn't understand what the economy coming out of that was going to look like. So when inflation starts to hit, you'll probably experience this. When the inflation really started to get going, you go into the grocery store, certain things start creeping up in price, and your habits may change. You might think, I don't need eggs this week because they're so expensive, or I'm going to drive a little less because gas is going way up. But as inflation becomes more regular and routine in your life, and you're not expecting it to be 2% anymore, you're expecting it to be 5, 6%, you kind of give up trying to change your behavior based on what prices are doing. Eventually, you're just like, well, I'm just going to the grocery store, I'm buying groceries, and I just expect them to be a lot more expensive. And that's a very dangerous part of the inflationary kind of cycle, is this time when the consumers just expect inflation to be bad, because it's tough to get them to expect it to come back down. And some of the reason around that is when companies are in an inflationary period and the consumer expects prices to be up 6%, but maybe their prices are only up 3% because of their industry or some reason, then they're going to raise prices to 6% because they need to lock in profits for when inflation comes back down. They want as much wiggle room as they can between their costs and their profits. It's not just because they're greedy capitalists, I promise that, although they are probably greedy capitalists as well. So this chart here shows kind of what our expectation over the last couple of years has been around inflation. Now, shockingly, it looks just like inflation because it's a major predictor of what it's going to be. But in last year, in the middle of June, we expected a year from them, which would be 6 months from now, that inflation would still be 7%. So 6 months ago, we were still super pessimistic about whether inflation was going to come down. But then, over the last 6 months, just last December, we were predicting a year from now in December that inflation would be 3%. This is just kind of consumer expectations around what it is. Now, there's an interesting part in this article right here. Short-term inflation expectations are often just a reflection of whatever is happening with gasoline prices. And, gasoline price is one of those things that virtually every American can tell you what the price of gasoline is, whether it's been going up, whether it's been going down. And often people just associate inflation with gas, because gas is a major driver of inflation all throughout the place. So it does help that during this time period, the price of gasoline has been coming down through it. Oddly enough, I see this exact same thing. I use this example around 401ks, where people come in the office and they tell me that they think the economy is doing poorly. And I ask them, is that because your 401k is down or your investment account's down? And it's often like, well, yeah, I mean, like, if the stock market's down, then the economy must be doing poorly. Not the case. Just like gasoline prices is not always the major driver of inflation. The stock market and your investments may often move in very, kind of different places. But these two major drivers, what inflation is now and what we expect it to be, are very important in understanding this idea of like, is inflation going to go back up or is it going to continue to come down? We're likely to see inflation continue to cool when we see consumer sentiment like this. Now, if you want to understand the bigger inflation story, I do have a video here that goes over kind of what inflation has been doing recently and the whole story last year. Otherwise, I hope this has been informative. I will talk to you soon. Thank you.